Hi, I'm Steve Clapham, founder behind the balance sheet. I'd like to tell you what I think is important when you're looking at your portfolio for 2021 and beyond. And I'm going to start by looking back at 2020, which obviously was a very exceptional year. And the reason I think it's important to look back is 2020 saw an amazing bifurcation of results. If, when we all went into lockdown, all you'd done is said, oh, look, we're all going to be stuck at home. We're not going to be able to go out and eat or travel. And we're going to be much more reliant on tech to deliver products to our home. Whether it's buying food online or engaging with friends and colleagues over Zoom. That's a very simple conclusion to have drawn. Anybody could have done that. You don't need to be smart. You don't need to be a stock market investor. A young kid could have come to that conclusion. And guess what? He or she would have made a lot of money because simply going long those tech stocks and going short the travel and tourism and hospitality stocks would have made you a 2.4 times return up to the date the vaccine was announced. So the big picture, getting the big picture right, was incredibly important in 2020. And what did we see? We saw a load of speculative activity, which is carried through into January 2021, obviously with GameStop and what's happening with the Redditors. But just think about what's happened to a stock like Tesla. It's gone through the roof. The Tesla chart, the Bitcoin chart, they all look the same. I'm not making any comment about Tesla, but if you look at a stock like Zoom, I don't see that there's a huge amount of upside. I think many of these stocks have been significantly revalued. I'm not saying they're a short, but I'm saying that you may think about there being better value elsewhere simply because so many of these stocks have done so well. But let's think about what's going to happen to the economy, and let's think about what's going to happen to our macro investing backdrop over the next 12, 18, 36 months and longer. And COVID has obviously been a dominant force in this, and it's affected two groups very differently. And I call this the Chevron effect, because one group's seen a big benefit and one group has seen a big disbenefit. One group's been really hurt. So who are these people? Well, the first is the employed, the well-paid people that are in a secure job. If you've been employed as an asset manager, you've not been able to go out, but you've been able to do your job. And guess what? The stock market's gone up a lot. So you've probably got a good bonus and your stock portfolio will have gone up a lot. If you're rich and you've got equities, you've done really well. And because you've not been able to go out, you've not been able to spend. So your cash balances have been increasing. That means that when we're released from lockdown, there'll be an increased propensity to spend by these consumers. But remember, you can only buy 3 meals a day. You can't buy the 2020 meals in 2021. In contrast, think about those people who are employed but aren't in a secure job. They're employed in travel, in tourism, and hospitality. It's the biggest employment sector in the world. Or say you've been self-employed and you've become very indebted because you've got a store and you've been closed for a large chunk of the year. At the bottom end, particularly in the US, many people have received a huge amount of help by government payouts. And that's been a really positive thing. But guess what happens if you're in the hospitality industry? You might have lost your business. You might have lost your job. Or your employer may be at risk and you're scared of losing your job. All this group will have a much lower propensity to spend, particularly because the lower paid, if they see a contraction in their income, that is translated 100% through in reduced spending. There's a much higher gearing to consumer disposable spending, consumer disposable income and spending for the lower paid than there is for the higher paid. And obviously it's a much larger segment of the population. So COVID has affected these two groups very, very differently. And it's quite hard to determine the balance between these two. There's many, many lower paid people sadly at risk with a reduced consumer spending, and the rich can't compensate. As I said, they can only eat 3 meals a day. So the outlook in the medium term may be a more difficult economic environment. It'll be balanced by government stimulus measures, but when they stop, the economy will be a lot tougher. And I also want to mention inflation, because inflation hasn't been an issue for over 35 years. And so many people investing in the stock market today won't be familiar with it. And I believe it's going to be an issue again. I think we could see inflationary spirals, particularly if we do see a pent-up demand to spend, which gets released in the third or fourth quarter of this year. And if we do get that sort of inflationary spiral, not only will pricing power be critical, but so will cost control. And I believe it's coming, and it will favor commodities. In the past, inflation has tended to favor value over growth. But historically, inflation has been accompanied by much higher rates. And that may not be an option for central banks this time. They may not be able to choke off inflation using the interest rate mechanism because they're so indebted themselves. And I believe it's most likely been the rates effect which has compressed the multiples in the past. In the past, when inflation has gone above 4%, stock market multiples have collapsed. That's probably due to increased rates or the perception that interest rates will be higher in the future. It's not clear what will happen this time round. So we've looked back now at 2020 and talked a little bit about the macro backdrop. I now want to turn to what might happen in 2021 and how do you protect your portfolio.